Hello everyone, welcome back to Financial News. I'm Ron Jankowski with Channel 4. My co-host is Paul Munichol with Ameriprise Financial. And Paul's going to give us an update as to what happened. Today is May 1st, 2023. A lot of things have taken place, Paul. I'm going to let you take it from there. And I have the latest things that have taken place this morning from Ameriprise, and I'll share that after your report.
Great, thanks, Ron. I'm going to hit up talking about homes today, and specifically home prices that are still up, believe it or not, on a year-over-year basis. New and existing home sales have dropped sharply over the last year amid a rapid increase in mortgage borrowing costs. Now, according to the Mortgage Bankers Association, the rate on a 30-year fixed mortgage ended March at 6.4%, as compared to its year-ago level of 4.4%. Now, in March, existing home sales were down 22% from their year-ago levels. Though a significant decline, the number was well off its recent lows. In the November through January period, existing home sales were more than 30% lower year over year. Now, in this environment, it would be logical to assume prices to be much lower as well. However, as many know, the number of existing homes available for sale is close to multi-decade lows, thus offering strong support to prices. In March, there were 870,000 homes available for sale in the U.S., that according to the National Association of Realtors. Now, though that sounds like a large number, it's near its lowest levels since records began in the early 1980s, and it represents a very tight market relative to population, which is about 332 million according to the Census Department, and U.S. households about 131 million, again according to the census. Now, given the exceptionally tight market conditions, existing home prices have essentially stalled rather than declined. According to last week's report from the Federal Housing Finance Agency, existing home prices in February were still 4% above their year-ago levels. The FHFA House Price Index is different than the price measures released each month with existing home sales data from the NAR. The HPI is a weighted repeat sales index, which looks at prices in terms of repeat sales or refinancing for the same property over time. A lot of data has been sourced from FactSet to support these. So if you're looking for more information on the topic, I can get it to you.
And we will talk how people can get that from you.
Sure.
And as of this morning, this information just came in. U.S. stock index futures are flat this morning after finishing about 1% higher last week, led by tech and comm. And services markets in Asia closed higher, led by Japan. I guess they're saying a plus 1%, while Europe is trading higher by about 0.8%. At midday. Treasury yields are quiet with the 2-year at 4.1%, the 10-year at 3.46%. Bitcoin down nearly 3%. Gold is down 0.4%. WTI crude, interesting, is minus 2.2% after dropping 1.5% last week. Is there any news on that? I mean,
I'm
OPEC
sure
cut
there's
their
something.
thing.
I don't have any.
You don't have. I mean, something's going on, but why are our gas prices coming down? They're going up.
I mean, there's a lot more that the
Come
gas
on, Paul,
price.
I'll do something about it.
We've talked about this before. There's refinery, there's delivery issues. There's a lot more than just the price of crude for affecting gas prices, but that is a contributor to them.
I'm kidding, Paul.
I know.
Okay, year-to-date index percentage returns. S&P 500 a plus 9%, Dow Jones a plus 3%, NASDAQ a plus 17%.
Those are good numbers. I mean, it doesn't really feel quite like that given the way the year's been, but those are strong numbers.
But the market has been edging up last week.
We're trickling in the right direction,
Yeah.
which is good.
Well, thank you for that report, Paul. Stay with us. We are going to be right back with our show called Your Money. Paul has an interesting topic. Stay with us. We'll see you in a little bit. And we're back with our show called Your Money. An interesting topic, as I had mentioned, Paul has. Home equity line of credit. How to properly use that for changes in your home, upgrading, remodeling. Take it away, Paul.
Yep, so today we're going to talk about just exactly that, making smart choices with home equity lines of credit. Now, for those of you who don't know, a home equity line of credit, also known as HELOCs, can be a valuable and convenient way for homeowners to access the equity they have built in their property and help meet cash flow needs. Now, a home equity line of credit allows borrowers to draw funds as needed, making it a popular choice for financing home renovations, debt consolidation, and other expenses. Now, while it may be a more attractive option than traditional loans or other forms of borrowing, it's important to be aware of not just the opportunities it creates, but potential pitfalls as well. So diving in a little bit more, let's talk about how home equity lines work. Now, home equity line of credit is a revolving account that can be established for a set amount, usually limited to a percentage of the equity in your home, and accessed as needed. For fundings, you can access this. Now, while there are some nominal costs associated with establishing a home equity line of credit, it is typically less expensive to set up than other forms of borrowing. An interest rate is associated with any funds you borrow through your home equity line of credit, and in most cases, the rate charged will be variable and also subject to change as market interest rates move up and down. Now, interest is only charged when you've borrowed money in most cases, so you need to make good choices with your home equity line of credit. Borrowing against your home equity may be most effective in a couple situations. One, maybe you're paying off loans with a higher interest rate charge, such as credit card debt. Something else to consider is investing in maybe a home improvement that might increase the value of your home over time. Or possibly if you're funding a big ticket purchase that can be classified as a necessity, such as another car for the household. Also, paying for a major unexpected expense or providing a financial bridge if you should lose your job. Prudent borrowing is important with a home equity line of credit. So, for instance, it's best to avoid borrowing from this source of funds to make frivolous purchases or to pay for a vacation. When used, this money should provide a long-term benefit that will make the months and years of repayments and interest charges worthwhile. Now, some other things to consider. While home equity line of credit loans offer tremendous benefits to those who have built up significant home equity, it's also important to understand potential downsides to this form of borrowing. So, consider that your home, perhaps one of your most important financial investments, and quite literally the roof over your head, it's being used as collateral to fund other expenses. Now, that creates a risk in the event the market value of your home should decline, which may require you to pay back the debt sooner. Or, if you miss payments, the borrower could foreclose on your property. Now, even though the home equity line of credit is based on your home's value, interest is not completely tax deductible. So Only interest on funds borrowed to buy, build, or substantially improve the home can be deducted. And of course, you're going to want to talk to your tax advisor about any tax deductions before taking any action. One additional caution is to avoid looking at a home equity line of credit as a ready, accessible piggy bank. You need to be disconcerting in how you use this resource, as the money does have to be paid back and with interest, which can create a future financial burden if not used judiciously. Consider these home equity lines of credit as a part of your financial plan as you weigh the potential of how a line of credit and access how it will work with your overall financial plan. As always, it will help to talk to an advisor about the pros and cons for your own unique circumstances before you take any action with any kind of loan.
Paul, wouldn't a line of credit be something like a lien on your property?
Potentially. I mean, you need to talk to the lender about that
Yeah.
and everything before you take any
Because
action.
if you
on
sold
these.
your home, your property, that bill would have to be paid for either through the proceeds or paid
one way
off
or
in
another,
advance.
they're not
One
giving
way
you
or
money.
another.
You have to pay that money back.
Yeah, and I think it has to be paid upon a sale of your home.
I'm not sure all the specifics because each loan
Might-
could have
might
its
be
different.
different.
Yeah,
That
talk
might
to
be
your
a little
lender
different.
and your bank provider and understand the
That's
things you
very
bring
true.
up before you take any action.
But you really need to get the information about your line of credit and talk to your tax advisor and your financial advisor, because
Do it
you
first.
can get
Do it before you
yourself
take-
into trouble.
Exactly.
All right, Paul. Anything we need to add to the show about what's
Just if people have any questions on this topic or anything we talked about in the first half of the show, they can call me directly at 708-226-3412.
Thank you, Paul, for coming out and sharing that with the viewers. For Paul Munichlo with Ameriprise Financial, myself, Ron Jankowski with Channel 4, we wish you a good investment day.